Hi, this is Michael Carlin, president of Henry+Horne Wealth Management, with your Manage the Funds Capital Markets Outlook for the second quarter of 2020. This is a long-awaited, obviously much anticipated market outlook. In 25 years, I haven't been around a more confusing time for investors, for clients of all kinds and variety, and we are very fortunate to be joined by our favorite guest, especially for these kind of matters, Joe Tiber Kosmala, co-founder. How are you, Joe? Good morning.
Very good. Good morning, Michael. Happy to talk to everybody again.
Thank you. So listen, I wanted to start with something a little different, just a light anecdote about how things might have changed for you during this shut-in. I see you're at work, but for this shut-in, life has changed for many. For me, my biggest change is this chair right here, this lovely chair, which was only purchased for looks. Never, I'm in my bedroom. It was never to be sat in, certainly not sat in for 12 to 14 hours a day. So I'm finding myself hunchback. So I'll be periodically looking to stretch. And if I'm hunching, Joe, I'm trying to break that habit. Feel free to point it out. Just let me know. Give me a little signal.
How about you? The upside of the chair, Michael, is that you look very regal in it. So
I know I get a lot of feedback about the chair. So Joe, how about you? How have things changed?
Life changes. Oh my! I mean, top of the head immediately. Yeah. Never spent so much time with my wife and kids. And the fallout, both good and bad, is pronounced.
Yeah.
So that would be the overwhelming thing that's standing out. My kids, both teenagers, one a senior in high school, about to say goodbye, obviously going to go off to college. So very much the upside of things, but the daily grind and being around the family as much as this situation warrants, also some downsides.
Yeah. I'm just going to say yep. But enjoy those moments with your son. You know, I'm enjoying mine too. We actually did a fun COVID-19 how to talk to your kids about the stock market recently, which will be airing soon. So interesting anecdote that I saw, Joe. Believe it or not, people are booking cruises for next year. So this is the stat. In the last 45 days on the online cruise marketplace is a 40% increase in bookings for 2021 compared to 2019. I didn't see that. I didn't see that coming. And I'm trying to figure out, you know, how much of that is positive versus crazy. Because there's many that speculate a lot about what the future of industry is going to look like, but I can't find many people that are optimistic about the cruise industry. And then I see that. I mean, does that, as an anecdote, jump out at you and slap you in the face like it does me?
It does, and it's probably the first of many questions about, you know, and the conversation just nationally and globally really is the return to normalcy and the reopening conversation and that sort of thing, and how that actually is going to transpire. Nobody of which has the answer, of course, but things like this are case in point of you know, we just don't really know how things are going to unroll as things, quote, normalize again, you know.
We don't, and I'm going to take a quick peek at that first quarter, those first quarter numbers. So if you pay attention to your screen here, and if you, by the way, for those listening via podcast, you can always reach out to us at Manage the Funds, managethefunds.com, or Manage the Funds on social media. I'm happy to send you all these slides. But Joe, if you look at your screen, you'll see that the 2019 returns are laid out side by side versus the first quarter 2020. And what you'll see is that in some areas like small cap, international, emerging markets, we gave up all the gains that we made in 2019, which was a rather epic year. US large cap held in with a little bit of gains, net year on year comparative. But what a shocking turn of events. You know, so for me, what I look at is the sharp negative returns in the equity market. I'm looking at the different parts of the bond market and high yield and emerging market debt and global corporate debt down 12 to 4%. Municipals were soft. There was a pocket of time where munis were down 10% due to lack of liquidity. And again, the long short guys got hit in terms of those that were trying to guess the market, right or wrong, both sides. The lone standout was the U.S. Treasuries, as there was a real flight to quality. The amount of money that sought U.S. Treasuries as a safe haven was epic, huge, tremendous, big tidal wave. Any thoughts there, Joe?
Yeah, I mean, just big picture. I mean, I think so many things about this whole, first quarter and in March in particular are so shocking. And to me, one of the most pronounced is how positive things were heading in to this downdraft. On the back of 3 Fed rate cuts really happening globally. So monetary stimulus coming in, a kumbaya with China with regard to a trade agreement in January. Things were definitely all the way up in through February. Things were just big picture market wise, economically speaking, were looking really positive. And then on a dime, this happened. So the velocity and the ferocity with which this happened is pretty mind numbing. Needless to say. So
it is, and the amount of volatility that we saw in the market, eclipsing previous other highs in market volatility that was confidence shattering to a lot of clients. But I feel like what I could get from clients in our phone calls and in our meetings was a different sense of alarm and panic than I had seen before. And I think a lot of it has to do with the fact that this is something that was felt across all spectrums. This is something that, the shut-in brought this economic slowdown to everyone's doorstep immediately, where, in 2008, banking troubles and banking woes hit the portfolio, which is different, very different than this kind of economic shutdown, which I think is part of the reason why it's so jarring. I mentioned again the VIX hitting an all-time high, taking out the 2008 number, and that leads us into really trying to get our arms around a reasonable forecast of what corporate earnings are going to look like going into the year. And, I've heard a variety of different estimates, but anywhere from, -10 to -50 to -8. I mean, I've seen it all. I want to have a little bit of a conversation about it. I have a graph here, a chart. We had, peak unemployment rate of 10.8% in 1982. And what went along with it was an S&P decline of 19%. The last time we saw major earnings declines was, of course, the dot-com bubble bursting of 2000, which this feels very different, and the financial crisis as well. So as we're trying to handicap what these earnings are going to look like, Joe, I'll just put it on the screen and I'll let you run with the football from here. It depends upon which sector we're talking about. There, as you can see on the graph, there's energy, which is you're looking at a -50% projected earnings crunch in 2020, to where a place like tech is expecting some earnings growth. So help us kind of, in your opinion, for the data that you see, how do you see this coming together with earnings, and where do you think we should be comfortable sitting versus where we were last year and what we were projecting for 2020?
Yeah, Michael, thanks. This is one of those things that anybody who's being honest is going to answer the question with, I don't know, because nobody truly knows what earnings are going to shape up to be. What we can look back at history, and we do know that the average recession, the decline in earnings in the average recession is roughly 35%, about 32%. So that's one thing that we know. Earnings season began last week in earnest, and we saw with the banks for the most part. And the banks have been one of the sectors that have been very much punished in the stock market due to concerns about their loans that they've made going bad, obviously going into default. And earnings, for the first quarter with most banks were anywhere between 45, and Wells Fargo posted almost an 80+% negative first quarter. So they're really all over the map. It's definitely sector dependent. I think one really interesting thing is that the earnings results of this downdraft can look arguably very differently than the economic downdraft itself. And that's just because when you talk about earnings, you're usually talking about the S&P 500. And implicitly, talking about the S&P 500, you're talking about technology companies and healthcare companies and financials, sort of those three, and particularly technology, obviously. So will tech earnings be as damaged as the broad economy? I think the indices, in short, can look a lot different than the broad economy, just because the indices and the weightings of the indices look quite a bit different than the broad economy. So Time will tell, and again, I think it's going to take time. I think the more important question, honestly, when you're talking about earnings is what is 2021 going to look like?
Right.
Because very importantly, that's what the stock market is pricing in. It's not pricing in what Q1 earnings were this year or even Q2. It's discounting forward earnings over the next couple of years. So I think the more important question is what does the reemergence and the reopening and therefore the earnings environment look like maybe in calendar year 2021 too.
Yeah. And we're gonna. That's a great segue because we are gonna throughout this podcast, this meeting, this session is dive into the data, and we are going to get into some more granular thoughts about what we're expecting and how we're evolving portfolios. But let's just go ahead and work our way through some data. And of course, this shouldn't be a surprise, but the U of M consumer sentiment numbers, which again aren't fully updated through where we are today in April, but wow, did they look terrible. Largest drop, shortest, largest, biggest drop in recorded U of M sentiment history. And it's particularly of note because we can't forget the fact that we are a consumption-based economy, and based upon how consumers feel is going to dictate and oftentimes how much they end up spending. So we are watching the consumer sentiment. We are aware of kind of that real notable change. But right now, given that data point, Joe, I say we kind of write it off as incredibly bad news, but when everyone's shut in their home, of course, what do you expect? We're going to need to really see what that data looks like when things start to open up a bit, I would think. So I feel like we can just kind of check the box on that being, we've talked about it, it's terrible, and we'll move on. Is there anything that we, yeah?
Well, yeah, I mean, one thing that I think you and I were talking earlier this morning, one thing about retail sales, and China's numbers came out last week, right, and so did ours. I think an interesting point, just to try to extract or pull some consumer behavior, out of this. Retail sales for March in the U.S. was down 8-9%, so a pretty draconian number. But when you back out autos and gasoline and food, so look at a core retail sales, March only fell 3%.
Right.
So again, back to your opening with the cruise lines, I think there's an underbelly consumption baseline that it'll be really interesting to find out where that is. But again, that's going to really surface and matter today for what that baseline feels like in 2021. But yeah. I
know. Yeah, you're right. That's a great point. I forgot about, that point about when you strip out auto and gas, which of course are going to be mind-numbingly horrible, and they were. We are going to talk about oil a little bit in a minute. Everyone's getting enough COVID-19 information, so they don't need to come to us for the latest health data there. But let's just look at it from an economic standpoint, and let's move through it quickly, because my expectation, my understanding is that the clients that I speak to are absolutely staying on top of the CNN, the Fox News, and/or MSN. Data points about what the COVID-19 numbers look like. But I just want to go through the economic impact of it. So I'm going to go through just a little bit here on the screen. So I'm going to share this. So again, if you see, COVID-19 cases confirmed by country, if you look, wow, do the Spain numbers, do they just jump off the page? Here you've got the US numbers, which again, are equally alarming. But Joe, I'm looking at the changing projections. There was a lot that was forecast by our own team of experts a couple of weeks ago, and those projections have come down favorably in the favor of things being, albeit still difficult and still challenging. And we do hope that everybody in your family and your network of friends are happy and healthy given this tough time. But the projections were coming out a lot hotter, and a lot heavier. And forecasted number of hospital beds needed from 250,000 down to 86,000 in a matter of 8 days. Forecasted ventilators from 31,000 to half that in a matter of 8 days. So Joe, looking at these projections, and I've got something else up on the slide here where we're talking about how to flatten the curve, and we'll go through some of this stuff in greater detail should you need us to on a one-to-one basis about the kind of things we expect the government to be doing. But large picture, Joe, given where we were projection wise and how some of those numbers have come down back to things that are less alarming. How do you read what's going on with COVID-19 right now, economically speaking?
Yeah, no, I think you just hit the nail right on the head, Michael. I mean, we the way we're looking at this, and I think this really is just an echoing of the market sentiment over the past, 2 weeks, 3 weeks. I mean, since the March 23rd low, markets have started to, I think, grasp onto maybe a bit more of a glass half full case, and that's with respect to the models, and as faulted and difficult of a modeling environment that it is, the fact remains that overwhelming majority of the models, as you said, have been overestimating both the mortalities and the sad stories and the healthcare infrastructure overload. So fortunately, they've been missing to the upside. So I think the markets are latching into maybe a revised reality of what these models have been predicting, number one. Number two, and the four big things, I mean, treatments, there's also advances in the science side of things that have come online very quickly. And again, sticking to market focus, I think the markets have been latching onto that. The fact that, Gilead, with the treatment last week here at actually University of Chicago, clinical studies. So whether it's treatments or testing, PCR testing, serology testing, so PCR testing actually for indications of COVID, or serology testing, maybe more importantly, or as importantly, certainly, testing populations for antibody, in the presence of antibodies in bloodstreams. And some of those numbers are coming out startlingly on the antibody side, startlingly high, meaning or suggesting that the virus has run its course. And that backs into a higher potential immunity baked in, and maybe a bit more of a confident reemergence of economic activity case. So all those things combined with the economic case of containment measures, flattening the curve, and the success that we've had so far, on that front, just balances out to, again, the market sort of latching on to a glass half full case, very much bolstered by governmental moves, monetary policy moves.
Perfect fold in. And I do believe that the market is fairly optimistic on the COVID-19 numbers. So hopefully what we are seeing continues to come through and we continue to get positive surprises there. But you're right, the Fed, we can't do this market outlook without trying to wrap our head around what the Fed has done. The last time we sat down, Joe, we used to have short-term rates. There was a positive number. Now the Fed took that down to zero immediately. The Fed was, again, being super accommodative, aggressively so. But my goodness, they didn't stop there. I'll share my screen again here, and if you look, the Fed has been buying nearly everything from asset-backed securities, investment-grade bonds, agencies, munis, providing some needed relief there, treasuries, commercial paper repos. I spent a bunch of time talking to clients this past quarter about how disconnected the bond market was and how unusual the pricing was, even on some of the most conservative and liquid securities, seemingly overnight. There was such a drive for businesses, business owners, consumers to be reining in and grabbing as much money as they could that it just decimated the bond market. So the Fed did come in and provide some help and stability there, which is appreciated. And I want you to comment on that. And then also I've got here a rather busy chart, but what it indicates is that what the Fed was doing here in the United States to provide relief, to inject liquidity into a whole different variety of investments and investment types, to provide that stability with the prices, which helps with what you're seeing on your statement, it was happening across the world as well. So Joe, how do you handicap what was going on, not just here in the United States, but worldwide, with Federal Reserves all over the world?
Yeah, so as we said as we were talking this morning, Michael, as unprecedented and the supply and demand shock and the economic shock that we've just witnessed has been, so too as unprecedented has the monetary and fiscal policy responses. So, you know, from a monetary side, speaking to the Fed and global central banks, the alphabet soup of programs was unleashed, and a lot of those, you know, were really just programs that were taken off the shelf from the 08-09 crisis. Many of them, but even more than that, because they created new programs. They went further. Let's be clear. They went exceptionally further than the global financial crisis back in 2008, 2009. Never.
And faster. It just, they didn't wait. There was no delay.
And right. Faster. I mean, and their charge, and I think the chairman did a pretty decent job of articulating this. Their charge was not necessarily, is not, to put money in the hands of consumers. That's the fiscal charge in businesses. Their charge was really more so to restore market functioning. And you said this. I mean, markets flat out were not functioning. A high quality AA muni bond should have somebody willing to buy it, right. But it didn't. And bid-ask spreads were blowing out, and the Fed stepped in immediately with a massive amount of balance sheet, to the point that it's grown $2 trillion already. So the Fed balance sheet, after the quantitative tightening, got down to about $4 trillion and change, in that neighborhood, just shy of that actually. It's already grown $2 trillion in the past 4 weeks. And is expected to probably hit 10 trillion, potentially up to $11 trillion. That is owning nearly half of the US economy in terms of size of balance sheet. So they're buying everything, supporting markets, they're unlimited QE, and so unprecedented monetary. The fiscal side, if you want to paint a little color on that as well, also unprecedented. So
unprecedented, yeah. I mean, again, we are accustomed to the fact that nothing is going to get done on Capitol Hill. We just have this base assumption that there will be so much infighting and so much politicking that no one wants to do this particular administration any favors to make them look good. But it got to such a degree that they were able to pass historic legislation. And, you know, it certainly is it's creating a lot of unintended consequences. I mean, I have clients that own businesses where some of their employees, those that are earning less than about $42,000 a year, are better off financially sitting at home rather than working, which is putting my clients and their businesses at risk, those that are still open, those that have essential businesses, where they still need to get work done, but they're having a hard time keeping the people in the seats. There's unintended consequences everywhere. We're also seeing that even like the PPP program, there was this morning, there was the first lawsuit brought out that Chase was picking favorites on who to give PPP loans to. There's always going to be unintended consequences, but the extent to which that we saw the Fed and the government step in should provide a significant buffer to the downside of what we would have seen had there not been any fiscal or monetary stimulation. You know, and I look in 2008 and 2009. You know, that we had kind of an economic growth trend, and there was the recession. And when we were recovering, there's kind of like a gap difference. That's about a 5% gap where we were on that growth line versus where we would have been had we not had the recession. I wonder if the speed with which that we injected all that liquidity, if it slims the gap. Too early to tell, but it certainly puts us on the right track to believe that the economy is going to rebound faster and better than it would have without it by a large margin.
That gap that you just referenced, Michael, I think is really important. Again, something else we talked about this morning, which is, I mean, quick definition, that's the output gap. So the difference between economic potential and actual realized economic activity, or in other words, economic slack. And that output gap, and to the extent the fiscal stem and monetary stem actually come in and mitigate that or burn that slack off, we think that's going to be a little while. You know, we think that gap is going to be there for probably a couple of years. And there's a takeaway, there's an investment takeaway to that. That investment takeaway is that means that we aren't at risk, despite this floodgate of liquidity, we aren't at risk in the near term to inflationary pressures. because there's slack in the economy that needs to be burned off. And that means we aren't at risk of interest rates shooting higher, again, despite the floodgate of liquidity, anytime too soon. So your bond portfolios, albeit yields are low and not exciting, we don't think they're at substantial risk right now. They're just underwhelming absolute returns for the time being. So,
and we're gonna have to at some point really break down, Joe. I want to do something more long form on this topic because they're clients of all different educational levels, to the most basic to the most learned clients that were former big business people that are in our network. They all believe in this, and they all have this basic economic understanding to varying levels, again, where money creation to that degree to them equals inflation. And we haven't had it. And I know that the slack is a component. I know that there's a component of the fact that given that everyone is kind of doing the same thing at the same time, not just our own central bank, but central banks across the world are doing it, it's helping muddy those waters a little bit. But my gosh, Joe, at some point you would have to think that one, all this money creation would lead to some unintended consequences. And the question is when and to what magnitude we would feel those things. That's for a whole separate thing, because that's a whole can of worms we could open up. But we promise we'll get there. I know that's going to be a question that comes out of this, so don't worry, Joe, and I'll break it down for you. I wanted to tilt a bit on unemployment. It would make sense. We need to at least address the magnitude of which this change has happened. Weekly jobless claims is now a new famous chart. Going back from the 70s, 80s, 90s, you can see indicated on the screen, to the financial crisis here, where we had a cresting of unemployment claims, to the magnitude with what we see here. And by the way, I couldn't put it to scale because the number is way off the screen. 22 million jobs lost through April 16th. And we got news over the weekend that places like Disney laid off 100,000 employees. We've got some more bad job numbers coming, and I look at it from this perspective in that we created 22.5 million jobs since the Great Recession. Joe, if we've lost 22 plus million jobs over the past number of weeks, it's easy for investors and clients to hear and see that and just say, you know what, this is horrible news for a consumption-based economy. And I know there's an aspect of it because it's temporary. Do you want to break down for folks why they might not need to be jumping out of their window quite yet?
Yeah, it's again yet another mind-numbing statistic that's come out here. 22 million jobs. The question, I mean, in terms of how we're looking at that, the question really is how many of those people that have filed will be back to work in 30 days, in 15 days, in 45 days. 86% of March's total job losses were categorized as temporary. So what does that mean? That means that the tie between the employee and the employer is not severed. So an employee can step back in a temporary unemployment filing scenario and come back in at the same salary level, same benefits level, as if that employee never left. So how many of the 22 million go back to work is the real question. And the answer to that is probably how long we stay shuttered, and how well the PPP and other business lifelines actually how well they work. So it's a stunning thing. The weekly numbers we are watching, 41 of 50 states anecdotally last week reported lower jobless claims than the prior week. So a little silver lining, potentially the peak obviously happened here maybe in the front end. We would expect it maybe to continue to taper off as the reopening conversations ensue.
Yeah, you would expect that those that are more tilted towards tourism and travel, those kinds of industries, your Floridas, your Californias, your energy-based states like Texas, you'd assume that those states are going to be worse. They also tend to be your larger employers. But I like that anecdote. I'll take it as a nice positive anyway, but we'll have to wait and see. I did want to turn our attention to where I think we're going to have a coming opportunity in the coming months and quarters, and that is within, commercial real estate. And I did mention, we've got the commercial mortgage-backed bond issue that has cropped up, and I don't think that's going anywhere anytime soon. And I think that this is again, another 30-minute conversation in and of itself. So I just want to hit the highlights. And for those clients that have specific questions, we're happy to break it down for you. But I think that there's going to be a coming opportunity within real estate. You've got large, you can even look at grocery anchored tenanted real estate where, 80% of the properties, the grocery, and the remaining 20% are those other ancillary businesses where many of those have either fallen vacant already, they're not able to find new tenants, or they're under significant pressure. You've got a lot of retailers that are going to be challenged. I'm looking at, the commercial mortgage backed rates for things that are, double B rated, and, 23% dislocation, what we're seeing there in the double B. We're seeing it, again, reduced sales on the commercial side. Joe, it just seems to me that what we may end up seeing longer term is a situation where you're going to have tenants that can't pay, properties that are falling vacant, yields on real estate portfolios dropping and or going to zero, creating opportunities for us to kind of proactively get in there, get involved in an asset that tends to do well when you have high inflation because rents go up and property values go up. I just feel like that, in combination with the fact that interest rates are so gosh darn low, that we're going to need to turn our focus onto real estate at some point in the future. Do you have anything that you want to add to that?
Yeah, no, I mean, we're paddling in the same direction, for sure. I mean, again, so much of this comes down to timing and the default cycle that's coming. And there's no question, you're right. No, there's no question that it's coming because checks will not get into every single needing or worthy business's hands in time to forestall the mortgage payments, loan payments, lease payments, et cetera. So defaults are coming. They're going to be pronounced in the real estate side, commercial real estate in particular, and viewing that as a buying opportunity is no question. In distressed situations across the board, there's no question that that's the right place to be looking right now. That's skating to where the puck is going, if you will. So, those sorts of things are definitely things that we'll be working with you specifically on finding the right way to take advantage of those opportunities, and something that we see. That said, again, the amount of money that gets into whose hands at the right time and the duration to which we end up staying closed is going to determine whether you're catching the proverbial falling knife, right, or you're coming into an entry point that would represent some longer term, attractive valuations too. So it's a needle we're trying to thread, but definitely we see that as an opportunity longer term.
Yeah, at the moment we're content waiting on the sidelines there, which we're just about to get to where we are portfolio wise, and I'll share a couple of different things with you here on the screen. Can't quite try to time the market. I say this, listen, I'm going to be really clear. We can't always be right. We won't always be right, but we do have a really nice history of reducing risk. Certainly we've done that a number of times. At a good time, we added risk most here recently. We'll talk about that in a second here with Joe. But some clients are asking, well, why do we have any money in the market right now? And it's because we can't completely take you all the way out unless we see something that is so obviously dislocated that we need to completely get away from that train. But look at this chart here. If you took that March low, March 23rd low as a sign that you got to get completely out of the market, and we had some clients call and ask if they should, you would have missed some of the best 10 weeks, one of the best 10 weeks since 1928. And by the way, the market is up, what, Joe, almost about 30% from the bottom, which has been incredible. And again, if you look at, the severe drawdowns and recessions, I mean, timing the bottom, not advised. You can go case after case after case in that it doesn't pay to get completely out of the market. But what we do try to do is oscillate, where we're trying to remove risk or add on additional risk while protecting client portfolios. Most of our clients, their first objective is capital preservation, which is essentially don't lose what I'm giving you. The secondary objectives could be income and or growth. And certainly times like what we've been experiencing, that number one capital preservation goal comes to mind for most. And we've experienced really good results, mostly given the fact that our largest exposure for any one area of the market going into this economic environment that we've been in was municipal bonds. So that helped shield our clients significantly. But we also made some other moves, Joe, with you and team that turned out to be really well. Do you want to highlight some of those? You have some of them handy?
Well, yeah, I mean, the big picture here, just in terms of adding risk and reducing risk, right? So when markets are feeling extended or for one of various reasons, you could look at managing your risk and just being judicious about taking it down, which was really the trend throughout 2019 into 2020, but staying still pretty constructive because what I think the most common, this is not something I think, I just know that the most common mistake investors make is, and I paint this analogy of you're standing on the beach and you've got waves lapping up against your shins. You're standing right there on the beach and you're looking straight down at the waves hitting your shins. But if you just look up and take a look at the horizon, you see really smooth water out 12, 18, 24 months. And that's probably the most violated tenet of investing that people make. And it's probably the one that is the most important to be cognizant of, that being not getting too mired in near-term volatility or the water hitting your shins, but maintaining a focus. If point A is today, point B is the horizon, point B is even 2 years out. And a show of hands in late March at our investment committee of will the market be higher or lower 24 months from now, 18 months from now? There was an overwhelming show of hands that the market was going to be higher in late March of this year, looking at 2021, 2022. So time horizon is paramount with regard to how you judge your investing. As with your models, Michael, for Henry+Horne, we never picked the bottom of the market, but we did add to risk in your portfolios just by happenstance. As you know, on March 23rd, that's pure luck, beginner's luck.
Joe, we knew what we were doing. Come on, but, we nailed it. But yeah, that worked out great.
And it was important, and it was intentional in a couple of ways. One, it felt like capitulation selling. For those of you who were watching the market that week, that was the week that the fiscal package was getting kicked down the road, and it was not going to get done, but it was supposed to on Monday. By the end of the week, it still wasn't done, and we had capitulation selling without question. Massive moves down in the market, et cetera, et cetera. So adding to the market in a time that feels like capitulation selling, and then how? So what we did is we sold very high quality safe and bought index equities specifically. Now going with indexed equities, A, they're cheap, but B, the rising tide coming off lows like that lifts all boats, importantly, including businesses that might have more suspect balance sheets and the like that are just happen to be included in the index. So we're really intentional with taking money off of very short-term, very conservative, just judicious amounts, of course, but then adding those to indices specifically, so passive markets. So that's one of the trades that we made just in the first quarter.
Yeah, and it just, and it was, well, just to highlight this other thing, this other note is that those, part of the market, now our largest exposure in equities is small and mid cap, where it had not been anywhere near close to that, and it just happens to be the greatest small mid cap short-term run in market history. But okay, rather be lucky than good, I guess. But that worked out really well. So I'm going to get into cash on the sidelines, oil, and then wrap up. So cash on the sidelines first is, I just want to make a note. that we see that there's cash on the sidelines. 4.22 trillion as of last read that I saw. It eclipses where the cash piles were as of 2008, which were under 4 trillion. That cash at some point, Joe, is got to find its way out of 0% earning, money markets and or cash funds. It has been a remarkable turn on the dime where money markets not that long ago, just a few months ago, you were getting 2% or more. And you got to see that, again, dry powder got to find its way home at some point. We'd like to think that's part of our thesis as to why the market moves higher. Certainly, maybe not in the immediate term, but that is going to provide in the additional bounces and surges that we need as the amount of cash that should be sitting in money market normalizes, and then the amount of money that should be looking for growth again normalizes as well.
Yeah, pent-up demand. Pent-up demand. So cash on sidelines. Michael's right. Cash on sidelines, as measured by M2 or money market fund holdings and the like, at record highs. So that is no question. That's pent-up highs and holding a little bit of dry powder, which we are in your models right now. We do have a bit of cash, so that warrants mentioning. Looking at cash.
In my history, Joe, I've never held more as a percentage of client portfolios. We are looking for the opportunistic areas to be investing. So for us, we continue to be defensive. Market's down today. We'll have to see what happens tomorrow and what the rest of the week brings. But we are actively looking for opportunities, which brings us into oil and energy. This morning, oil had a day that like none other. Down to $11 a barrel. Again, if you look at future contracts for oil, obviously it's contango, it's higher consecutively month after month after month. But this is an eye-poppingly bad number because we finally achieved some levels of energy independence, creating a great energy economy here in the United States, and then this has to happen. We're producing too much oil. We don't have anywhere to put it. It's good from the fact that, for consumers that whoever is filling up their tank, I don't know anyone, but for those that are filling up their tank, they're doing it for less. But man, we have started to put a little bit of money in energy, which I've seen, and we're going to continue to look for opportunities. We've identified a couple of energy companies as a part of a COVID-19 portfolio and an energy ETF. So I think what we're starting to do is see some, again, capitulation selling here where we're taking a step in.
Yeah, energy is one of those things that that we think long, again, looking at the horizon, not at your shins standing on the beach. That's one of those things that energy prices just globally cannot survive. Energy companies cannot survive at $12. So they'll all go bankrupt. The picks and shovels, as well as the exploration and production companies. So the lifting costs virtually across the board, particularly here in the U.S. The average lifting cost per barrel of oil in the U.S. across the Texas energy patch is the low 50s. So, and now there are properties that can produce profitably in the high 20s, low 30s, but the average is actually up there north of 50. So
few and far between.
Yeah, exactly. So Russia needs it higher, Saudi Arabia needs it higher, the United States needs it higher. Therefore, we do expect production cuts to eventually push oil back to a profitable level for all producers. That said, and the forward curve does suggest that. The forward curve, looking at WTI 12 months out, the forward curve is suggesting on Brent or WTI, U.S. or non-U.S. oil contracts, are suggesting 40 to 75% higher levels than where they are today. And that doesn't even include today's move as well.
True.
So,
yeah, it's true. I've seen that before. I've seen it before, even when oil goes super low. You do see oil to be higher in later months, but we're going to have to see. So again, I just want to be really clear. We are not making a blanket recommendation to anyone listening that they go ahead and use this as an opportunity to load up on energy. But for our clients, we are with a lot of careful diligence, and we're paying attention to total exposure while maintaining the capital preservation as that number one objective for most. How's that for disclosure? We are feathering, my new favorite word, feathering our way into energy a bit. So again, all this is again leading us to hinge on the fact that how we have kind of this great reopening and what the great reopening looks like after the great closure that we've been experiencing here over the past number of weeks. I'm not going to ask you for a prediction, but it just seems to me, Joe, that, as the economy comes back online over the coming, if it happens in weeks and or months, that sense of relief will meaningfully improve people's economic outcomes, likely consumer spending. And it's the kind of thing that has the good animal spirits across lots of different areas of the economy. Is there things that you're looking for, the way that you look at reopening that you'd like to share?
In terms of the magnitude, again, I can't pretend like I have any insight because I've never been here before. I wasn't alive in 1918, 1919 when the Spanish flu devastated the US and the world. But I do know that was followed by the Roaring *20s. Right. As well. So it's really going to be difficult to handicap. I think the stock market is beginning to handicap it today, and over the past several weeks, obviously. I think, but time will tell. I think we're going to have anecdotal stories like the cruise lines booking up for next year, right alongside hesitation in some pockets, some industries, hesitation to return to normalcy. At the same time. So I think it's going to be a fits and starts, more of not a V-shaped recovery in consumer behavior, but rather a Nike swoosh style recovery in consumer behavior, something like that.
Man, it would be great to see a V-shaped recovery, again, sharp down, sharp up, but again, that swoosh is what most of the folks that we respect the most, Joe, you included, have been talking about. So listen, we killed it. We went long. We always seem to go long. We have expectations that we're going to try to go shorter, but we can't. We try. So this has been your Henry+Horne Wealth Management second quarter 2020 market outlook with Joe Tybert. Thank you, Joe. You were amazing as always.
You're welcome. My pleasure, Michael. Always a pleasure to work with you, and appreciate all your clients.
Thank you. And again, if you need to find us, we're at Manage the Funds on social media, managethefunds.com. That's it for today. Take care and have a great week. Bye-bye. This program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry+Horne Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry+Horne Wealth Management, a registered investment advisor. Henry+Horne Wealth Management and IFG are separate and unrelated entities. Henry+Horne and Henry+Horne Wealth Management are separate entities. Member of FINRA and SIPC.